The AI boom has been a series of bottlenecks. First GPUs, then data center equipment, and currently it's memory chips that are in short supply. Electricity demand has been on the radar for a while, but it's likely to become a bottleneck over the next year or two. This is the one everyone's seen coming, and a lot of stock prices reflect that fact. But the ripple effects could affect a growing list of industries, and that's where the uncrowded opportunities might be. I'm Billy Bob, and as always, I'm joined by our brilliant market analyst, Sarah. Sarah, how are you doing today?
Hey, Billy Bob, I'm doing great. Excited to dive into today's topic. We've got two fascinating companies to discuss that are absolutely at the center of one of the biggest investment themes right now. We're talking about Constellation Energy, ticker CEG, and Vistra Corp, ticker VST. Let me break it down, our viewers. Constellation Energy is based in Baltimore, Maryland, and they operate the largest nuclear generation fleet in the United States. We're talking about 21 nuclear reactors across multiple states with over 19,000 megawatts of capacity. They generate and sell electricity from nuclear, natural gas, hydro, wind, and solar facilities to utilities, retail suppliers, and large industrial customers.
And Vistra?
Vistra is based in Dallas, Texas, and they're actually the largest competitive power generator in the U.S. They have about 41,000 to 44,000 megawatts of capacity across a diverse portfolio: nuclear, natural gas, coal, solar, and battery storage. What's interesting about Vistra is they have an integrated model. They not only generate power, but also sell retail electricity directly to consumers through brands like TXU Energy.
So both companies are essentially power producers, but they're getting a lot of attention lately because of AI and data centers, right?
Exactly. And that's where this gets really interesting. Both companies have signed massive long-term power purchase agreements with tech giants. Constellation has deals with Microsoft and Meta, and Vistra signed a huge 20-year agreement with Meta for over 2,600 megawatts of nuclear power. These data centers need 24/7 reliable, carbon-free power, and nuclear is perfect for that.
Okay, so let's get into our methodical analysis. Sarah, walk us through what phase these companies are in, according to your framework.
Great question, Billy Bob. Using our comprehensive business analysis framework, both Constellation Energy and Vistra are classified as Phase 5 capital return. Now, what does that mean? It means these are mature, profitable companies that are actively returning capital to shareholders through dividends and share buybacks. Let me give you the specifics. Constellation is paying a dividend of $1.71 per share annually with a 0.62% yield, and they've been growing that dividend by about 10% year over year. They also bought back $400 million worth of shares in the first half of 2025. Vistra is even more aggressive with buybacks. They've repurchased approximately $6.3 billion worth of shares since November 2021, which has reduced their share count by about 30%. They also pay a dividend of 91 cents per share with a 0.56% yield.
30% reduction in shares? That's massive.
It really is, Billy Bob. That's extremely aggressive capital return. And both companies have positive operating income. Constellation had $1.4 billion in operating income in the first half of 2025, and Vistra had $1.9 billion for full year 2025. So these are definitely not declining companies. They're healthy, profitable businesses returning cash to shareholders.
All right, so they're in Phase 5. What about their competitive moats? Are these durable businesses?
This is where it gets exciting. Both companies have wide moats, and I would argue those moats are actually widening right now. Let me explain the key sources. First, intangible assets. This is huge for both companies. Nuclear operating licenses from the NRC are incredibly difficult and time-consuming to obtain. We're talking 10-plus years and billions of dollars. You can't just decide to build a nuclear plant tomorrow. These regulatory barriers create massive entry barriers that protect Constellation and Vistra. Second, low-cost production. Once nuclear plants are built, they have very low marginal costs and can operate at 94 to 95% capacity factors. That's way higher than wind or solar, which operate at 25 to 40%. This gives them a significant cost advantage. Third, counter-positioning. This is the AI story, Billy Bob. Nuclear provides 24/7 carbon-free power. Solar and wind are intermittent. They need batteries, which are expensive. Tech companies building AI data centers need constant, reliable, clean power. Nuclear is perfectly positioned for this, and these companies are the ones with the assets.
So the moat is widening because of AI demand?
Exactly. The combination of regulatory barriers, low-cost baseload generation, and perfect positioning for the AI data center boom is strengthening their competitive advantages. New competitors can't easily enter this space.
Let's talk growth drivers. What's actually going to drive these companies higher from here?
Great question. Using our growth driver matrix, I rate the overall growth drivers as strong for both companies. Let me hit the key ones. New segments, AI data centers. This is transformative. We're talking about massive new demand from hyperscalers like Microsoft, Meta, Google, and Oracle. The International Energy Agency projects global data center electricity demand will more than double by 2030. Deloitte estimates U.S. AI data center power demand could grow 30-fold by 2035. That's insane growth. Price increases. Both companies have strong pricing power right now. Limited new nuclear supply plus surging AI demand equals the ability to command premium prices. These long-term PPAs they're signing are at much higher prices than historical averages. Operational efficiency. Both companies are industry leaders in nuclear operations. Constellation ranks number 1 in operational metrics. Vistra has a comprehensive hedging program with about 98% of expected 2026 generation volumes hedged, which provides earnings visibility. Strategic acquisitions. Vistra just acquired Lotus Infrastructure with 7 natural gas facilities, and they have a pending Cogentrix acquisition that would add 5,500 megawatts of natural gas capacity. That's significant fleet expansion.
Okay, so the growth story is real. Now let's get to the numbers everyone cares about. Valuation. What are the analysts saying, and what does the DCF analysis tell us?
This is where it gets really interesting, Billy Bob, because we have a divergence between the two companies. Let's start with Constellation Energy. The stock is currently trading at $274.06. Analyst consensus. Wall Street analysts are very bullish. The average 12-month price target is around $370, with some as high as $372. That's about 35% upside from current levels. The Zacks report shows fiscal year 2 EPS estimate of $13.68, and applying the forward PE of 23.36 gives us an implied target of around $320. Discounted cash flow, or DCF analysis from Simply Wall Street. The discounted cash flow model estimates CEG's intrinsic value between $272 and $317 per share. Recently, it's been around $288 to $317.
So for CEG, the analysts and DCF are both saying
the stock is undervalued or fairly valued. The current price of $274 is below both the analyst consensus of approximately $370 and at the lower end of the DCF range of $272 to $317. This is convergence. Both methods agree there's upside potential. Now let's look at Vistra Corp, trading at $163.75. Analyst consensus. Analysts are extremely optimistic here too. The average price target is around $230, with targets ranging from $230 to $231. That's about 40% upside from current levels. The Zacks F2 EPS estimate is $11.21, and applying the forward PE of 17.58 gives us an implied target of around $197. DCF analysis from Simply Wall Street. Here's where it gets interesting, Billy Bob. The DCF model has undergone massive downward revisions. In January 2026, it estimated fair value at $352. But recent updates in April and May 2026 show the fair value was sharply trimmed to $145 and then down to $133.54.
Wait, from $352 down to $133, that's a huge cut.
It's massive, and it reflects the DCF model's conservative adjustments to revenue growth assumptions, profit margins, and discount rates. The model is basically saying, look, even with all this AI growth, when we discount those future cash flows back to today at an appropriate rate, the math says the stock is worth around $135 to $145.
So for Vistra, we have analysts saying $230, but DCF saying $135?
Exactly. That's a huge divergence. The current price of $163.75 is trading at a discount to analyst targets of approximately $230, about 40% upside according to analysts. But trading at a premium to DCF fair value of approximately $135 to $145, about 13 to 21% downside according to the model.
So what's going on here? Why the disconnect?
Great question. I think it comes down to this. Wall Street analysts are pricing in aggressive growth from long-term nuclear PPAs, the Cogentrix acquisition, and the AI data center boom. They're looking at earnings multiples and growth trajectories. The DCF model, on the other hand, is more conservative. It's looking at actual discounted cash flows and saying the current price has already priced in much of the fundamental growth. The model recently cut its estimates because it's adjusting for things like more realistic revenue growth rates, sustainable profit margins, appropriate discount rates that account for risk. The fact that Vistra has $20.9 billion in debt.
Okay, so let's get to the bottom line. What should our viewers do with these stocks?
Let me give you my recommendations based on all this analysis. For Constellation Energy, CEG, buy. Here's why. Both analysts and the DCF model agree the stock has upside. Current price of $274 is below analyst consensus of approximately $370, trading at the lower end of DCF range, $272 to $317. Wide moat that's widening. Strong phase 5 metrics with growing dividends and buybacks. 8 to 10% EPS growth trajectory. The AI data center story is real, and CEG is perfectly positioned. The risk to reward here looks favorable. You're buying a high-quality business with durable competitive advantages at a reasonable price. For Vistra Corp, VST, hold or wait for better entry. Here's my thinking. The divergence between analyst targets $230 and DCF value $135 is a red flag. Current price of $164 is closer to DCF fair value than analyst targets. The massive DCF downward revisions from $352 to $133 suggest the market may have gotten ahead of itself. Yes, Vistra has amazing fundamentals, wide moat, aggressive buybacks, strong AI positioning, but the valuation math doesn't support a strong buy at current levels.
So you're not saying sell Vistra?
No, I'm not saying sell if you already own it. The business is fantastic. I'm saying if you own it, hold it. It's a great company, and maybe the analysts are right and we get to $230. If you don't own it, wait for a better entry point. Maybe around $140 to $150 would be more attractive, closer to that DCF fair value. If you're thinking of buying new money today, I'd be cautious. The risk reward isn't as favorable as CEG right now.
What would change your mind on Vistra?
A few things. If the stock pulls back to the $140 to $150 range, that would be a much better entry point. If they announce more major PPAs that significantly boost cash flow projections, if the DCF model revises higher based on actual execution and cash flow generation, if they successfully integrate the Cogentrix acquisition and show clear synergies.
Any final thoughts for our viewers?
Yes. A few key takeaways. First, both companies are exceptional businesses in a secular growth trend. The AI data center power demand is real, and these companies with nuclear assets are perfectly positioned. Second, valuation matters. Even great businesses can be bad investments if you pay too much. CEG looks reasonably valued right now. VST is more questionable at current levels. Third, use multiple valuation methods. That's why we look at both analyst consensus and DCF analysis. When they agree, like with CEG, you have more confidence. When they diverge sharply, like with VST, it's a signal to be more cautious. Fourth, these are phase 5 companies, so focus on free cash flow generation, dividend growth, and share buybacks. Both companies excel here, especially Vistra with that massive 30% share reduction.
Excellent analysis, Sarah. So to summarize for our viewers, Constellation Energy, CEG, buy, analyst and DCF convergence, reasonable valuation, strong fundamentals. Vistra Corp, VST, hold or wait. Great business but valuation concerns. Wait for better entry around $140 to $150.
That's exactly right, Billy Bob.
All right, everyone, that's it for today's episode. If you found this analysis helpful, please hit that like button and subscribe to Build Wealth Now News. Drop a comment below letting us know what you think about these two stocks. Are you buying CEG? Do you own VST? We'd love to hear your thoughts. Until next time, keep building that wealth.
Please do not forget to leave your comments below. See you next time.
Build Wealth Now News is dedicated to research the businesses behind the stock names. Our research are done with artificial intelligence assistance using the best practices in the industry. Please note that investing carries its own risk and you should do your own research before committing any stock to your own portfolio. This conversation is for educational and entertainment purposes only.